Welcome to Chapter 7. You will see that this chapter is really a continuation of Chapter 6. Now, except we are talking about the other side of the transaction. In Chapter 6, we focused on selling products. Well, before we can sell products, we have to buy the products and place them in our warehouse and on our shelves. This is called inventory, short-term assets that the company intends to sell to its customers. The inventory purchases process usually begins with a purchase order, which is an internal document completed by the company and sent to the vendor, the company who is willing to sell us the goods. Before a purchase order is completed, the company needs to know a few things. One, how much inventory do we already have on hand, which on hand is jargon for what do we already have in the warehouse and on the shelves. And two, how much inventory do we plan on selling in the next few weeks or next few months, depending on the inventory that we have. So for example, a grocery store is not selling milk that they purchased a few months before, but a tire shop will sell tires that they purchased a few months in advance. And so when we get to the next chapter, we'll talk about the budgeting process. Now, your book does not get into this concept, but you know I will. Internal controls. These are the policies and procedures a company has in place to ensure efficient operations, prepare accurate financial reporting, and prevent fraud, waste, and abuse. A purchase order is the starting point for a fraudster. Once the purchase order is sent to the vendor begins to process the order and sends the goods to the company or to whatever address is on the purchase order. Now, once those goods are shipped, then the company has a liability. This is why that purchase order process needs to be closely monitored and controlled. Now, in the last chapter, we introduced the concept of paying sales tax for products, not for services though. And the company sets a price for its goods, say $1 for a large cup of coffee from McDonald's, and then has the customer pay the sales tax. Let's say it's 9% sales tax. So a customer is actually paying $1.09 for the cup of coffee. $1 is revenue for McDonald's, and the 9 cents is a liability that the company will pay to the state and local government. Well, in this chapter, Chapter 7, we're looking at sales transactions from the buyer side. In other words, we're purchasing goods from vendors, but the same rules will apply. The vendor will set a price for the inventory, let's say $5 each, and then they'll also charge us sales tax. And let's say sales tax is 10%. Do some easy math. Here's what I want to get across. When we are purchasing inventory, we determine the cost of the inventory as all the costs necessary to get the product ready to be sold. That all the cost includes the $5 that is the price of the goods. It also includes the 50 cents for the sales tax, 10% times $5. Even the additional 25-cent charge for shipping the goods, and the 5-cent cost for repackaging the inventory with our own brand. So while the inventory is priced at $5, what we record as inventory on our books would be $5.80. We don't separate these costs separately into taxes, shipping, etc. These are all the costs necessary to get the product ready to be sold. Okay, that was a lot of numbers. So I'll pause and let you rewind the video to pick this up again. Did you rewind the video? Really? Did you rewind the video? All right, so another point about buying inventory. Remember in the last chapter, we were offering our customers discounts for paying early, the 210 net 30 terms, which means if you pay within 10 days, we'll give you a 2% discount. Well, our vendors are also eager to get the cash, so they will offer us cash discounts. When we take advantage of the cash discounts, this results in a reduction to the cost of our inventory. Remember, inventory is valued at all the costs necessary to get the product ready to be sold. So if we take the same information we just talked about, the $5 for the product, the 50 cents for the sales tax, and even the additional 25-cent charge for shipping, and the 5-cent cost for repackaging the inventory with our own brand. And then we add a 5% cash discount because we paid within a specified time frame. our inventory cost would now be $5.53. Huh? Yeah, that's right. $5.53. Do you want to rewind the video now? Okay. It's the $5 less the 5% cash discount, which is $4.75, times the sales tax rate of 10%, which is a total of $5.23, plus the 25 cents for shipping and the 5 cents for repackaging. So the discount is only applied to the cost, not the tax rate, not the shipping or the repackaging or any other costs necessary to get the product ready to be sold. So ultimately, we will sell the inventory. And when we do sell the inventory, we're going to reduce the inventory, it's a credit, and increase the selling expense, it's a debit. The specific selling expense that we use is cost of goods sold. Now, I'm not going to get into the details here, but the company has several costing methods that they can use to determine which cost to expense when inventory is sold. The three primary ones are LIFO, last in, first out, FIFO, first in, first out, and weighted average. Each method likely will produce a different result for cost of goods sold, which results in a different gross profit and operating income number. Same transaction, different results. So there is a video on inventory costing if you want to get a refresher on that. Now, eventually, the company will pay for the inventory. This is also something we have already covered in this class, but the book adds a new wrinkle, paying by credit card. So just remember, a credit card is a liability. So essentially, the company is transferring the liability from one account, accounts payable, to another account, credit card liability. Now, the book uses the term debit the credit card account and credit the credit card account. But they're talking about it from the perspective of the credit card company, not us, the company. So remember, for Visa, your credit card account is an asset for them. So when Visa debits your account, that means you owe them more money. And when Visa credits your account, that means you owe them less money. Okay, so that's enough of a summary. Go ahead and dive in. And of course, if you have any questions, I'm ready to answer them in the Ask a Question section. Have a great couple of weeks.